Alright, guys, so things are wrapping up once again. The West has frozen Russia's reserves, and Moscow has now targeted the assets of EU banks. And these are funds belonging to German and Italian banks still in Russia. It's quite interesting to know that EU banks are still operating in the country 2 years into the war. And the reason is quite simple, they are making a ton of money. The Russian economy isn't collapsing, in fact, it's running red hot. There's increased public spending, generous state subsidies for the Russian people, and military mobilization. And all this is pouring money into the economy. It's helping to raise GDP and living standards. As a result, people are taking up loans, they are buying homes, and consumption is on a tear. And this is where banks come in. There's a reason why European banks are still operating in Russia. Interest rates in Russia are set high to limit the economy from booming out of control. It's around 16% today. So banks with money in the country are raking it in. Even if they are issuing fewer loans because of Western sanctions, it's the EU banks are earning a ton of money. The profits of EU banks have jumped up. Raiffeisen Bank, which is Austrian, has more than tripled their profits in 2 years. The rest has also grown their earnings in Russia. Now that's great for the banks, but it also means they have billions of dollars in assets stuck in the Russian financial system. Money that just can't exit. Selling out of Russia, which will require government approval, it will be extremely hard to get it. You can exit, but you'll be selling at fire sale prices. And if you're Putin, as long as the West has your money, you're gonna trap your enemy's funds, right? Your opponent's funds in the country as well. So if Europe decides to give your assets to Ukraine, you can reach in and confiscate theirs as well. It's the classic tit for tat strategy. Western assets are trapped there unless they sell them away at a huge discount to Putin, which is another form of confiscation as well, if you want to be honest about it. So there aren't any good options for EU banks today. And now Russia has taken action. A Russian court has frozen $1 billion worth of assets from Deutsche Bank, Commerzbank, and Unicredit, German and Italian banks operating in the country. Now, the suit itself is quite interesting. The banks were supposed to provide guarantees for Gazprom plant. However, once again, because of Western sanctions, they had to withdraw away from the agreement. Essentially, it was a default of sorts. So Russia seized their assets, including shares and real estate. And this is shocking because it confirms the worst fears of the West. If a full confiscation of the 300 billion happens, there will be retaliation. The problem with confiscation is how much the West has to lose. It goes beyond just the assets. And if you think about it, the reward versus the risk just isn't there for them to take away Russia's frozen reserves. Looking at global forex reserves, the stakes are extremely high. Western currencies, including the euro, the yen, and the dollar, accounts for 90% of all reserves. 90% of all reserves versus just 1/8 of the global population. So you can see the enormous amount of control these currencies have, the amount of trust central banks still place on them. Confiscating the Russian assets is a clear overreach. You are risking trillions of reserves divesting away for what? For a maximum sum of just $300 billion. And there are even reports that the frozen assets are maybe only 200 billion at best. The problem now is a new breed of Western debt holders. It used to be central banks, but that situation is now flipping. And this is a problem, and you'll understand why. This chart shows us the amount of US debt held by foreigners. The black line is holdings of central banks, while the red line is holdings by private investors. And that can include individuals, companies, or even hedge funds. Over the last decade, the nominal holdings of central banks have stayed stagnant, and this isn't good. The world is getting much richer, but their holdings of US bonds aren't growing. On the other hand, private investors are buying more and more. They have reached almost the same level, parity, as central banks, around $3.5 trillion worth. And here's the big issue, private investors, people like you and me, we are very price sensitive, which means they demand a higher yield to hold the debt. Their main agenda here is to get a better return. Central banks are different. They hold US treasuries because they are liquid and just a place to store value. Private holders are faster to sell their debt than central banks. They can simply dump everything. So let's war game this out. If the West decides to confiscate the Russian assets, you scare away global central banks further. they start divesting away even more. You're stuck with the worst source of investors. You'll be left with all the cowboys, the speculators. Bond yields will become more volatile over time. And this isn't good for the US economy at large. And knowing this, you would kind of think that the West would consider confiscation a toxic strategy. It's just not worth the blowback effects. Confiscating $300 billion will risk the takedown of a multi-trillion-dollar bond market. What's the point? But that's not the case at all. Janet Yellen, the head of the US Treasury, is still pushing for confiscation. She's still pushing the G7 to issue freedom bonds for Ukraine, and the bonds will of course be backed by the frozen assets. At this point in time, it's probably going to happen. It's a done deal. They are just ironing out the details over the coming week. There'll be more and more confiscations on both sides. Russia states that they have their own Christmas list of Western assets to seize, and I think we should believe them in this. This includes companies, real estate, and land. Putin's just waiting for the shoe to drop before unleashing his own spree of seizures. Now, while the West and Russia are busy fighting, China is wrapping up their battle to revive the economy. And they are getting really serious about this. We've talked about how China would rather take their time, but that isn't possible anymore. They have to accelerate their timetable to boost their own domestic economy fast. Beijing is now facing two big headwinds. The first is the US containment of their industries, and we all know about that. It includes all the trade tariffs, the trade war, and tax sanctions. And if the West can get China to export less, they can slow down their growth. And we are seeing it across multiple sectors, especially in EVs and solar panels. Domestically, China needs to contain the property collapse as well, and it's all about reversing the sentiment of Chinese consumers. This is known as the wealth effect, and this applies to every single economy, whether it's the US or China. Since 2022, China's home prices have been dropping month after month. It has now reached nearly 5.6% decline in April last month, and this is putting a lid on consumer sentiment. And even if this is just on paper, when your net worth goes down, you're inclined to spend less. That is the wealth effect. You'll want to see a reversal or at least prices stabilizing before you are confident enough to consume. They have solved the problem with exports, right? Exports are growing like gangbusters around the world, and that's why we have the backlash of overcapacity claims from the West. But the domestic economy still needs work done, and that's why the Chinese government have brought out the big bazookas and they have fired a very big shot. They issued 1 trillion yuan worth of bonds, and we must talk about this. This is a massive issuance that equates to around $138 billion. The boost to GDP here could be as much as 1%. But take a look at the duration of the bonds: 20 years, 30 years, and even half a century, 50 years. China is borrowing more money at lower interest rates today, and they are locking them in now. This is what Yellen should have done when rates were dirt cheap in the US back then, back a few years ago. China is doing this now. They don't have to pay the debt back for decades, and this stimulus is coming at a very cheap rate. We can see Chinese bond yields dropping like a rock, especially over the past 12 months. The 10 and the 30 years are starting to drop down towards 2%. It's almost half the rate just 5 or 6 years back, and the reason is very simple. Because of the property collapse, domestic Chinese investors only kind of have two places to go for safer returns. Now, one of them, of course, is gold. The other is longer term bonds that give guaranteed returns. And because China doesn't have an inflation crisis yet, yields could continue to drop to stimulate the economy. So local investors, they are piling into Chinese debt in a big way. That's why the government is flooding the market with a trillion yuan worth of bonds. On one hand, they need to boost domestic consumption now, and on the other hand, borrowing money is kind of cheap. It's now or never. And here's the trillion yuan question: how will they deploy the money? And if China does this correctly, the economy will boom. It will shock the US. If they mess it up, they will inflate a new property crisis again. Let's explore this. China has to deleverage the debt burden of property developers, and this means preventing them from borrowing excess money. But at the same time, they can't let them collapse completely. To accomplish this, there has to be some sort of inflationary measure. And that's why we have the 1 trillion yuan bazooka. Beijing has to inflict both deflation and inflation at the same time. This is the ultimate balancing act. And here's the Chinese plan. The main push is to reduce the inventories of homes in the open market. In other words, buy up the supply of houses to stabilize prices. To do this, China's reducing the down payment on homes and they're about to pump in $42 billion to buy up unsold homes. For example, if you're a first time buyer, you only need to put up 15% now. If you're buying a second home, that's only 25%. Both down payments have dropped by 5%, and this brings them down to historically low rates. China's trying to get people back into the property market by lowering the barriers to entry. They want buyers back into the market. The second strategy China's doing is even more radical, guys. It's a re-lending program to allow state companies to buy up homes. And this is where the $45 billion comes into play. And check out the details. 21 lenders and banks will be given $45 billion at a rate of only 1.75% for up to 4 years. And this is cheap money at a lower borrowing cost. Banks can take this money and lend it to state-owned companies to buy up unsold homes. It's basically a bailout by the Chinese government. The money is channeled through the banking sector and homes are bought by the Chinese versions of Freddie Mac and Fannie Mae. Now, won't this inflate the bubble again? Isn't this a moral hazard? Now, firstly, this is very different from the '08 bailouts of Wall Street. The Chinese government is essentially now the provider of homes. Real estate developers are still barred from excessive borrowing. This is not a bailout for the rich, but a bailout for the masses. And there are two guardrails China imposed on this scheme. State companies with a lot of debt can't participate, and this is to ensure that the firms don't suddenly just collapse. Secondly, the homes are used for only public housing. The houses have to be sold off or rented out to people. Now, can this work or would this just collapse? It really depends on how the state allocates the money. But the biggest winners here are the Chinese banks and the developers because President Xi just prevented a further collapse. And that's why their stock prices have risen by 20%, 30%, or even in some cases 40% within a single week. Everyone's bullish because the property crash might have bottomed out. This might be the big turning point for China's economy. China's bailout is extremely specific. They aren't flooding the market with stimulus checks. They are instead making it really targeted to the property sector. Let's not forget that. And let's end this with the new China Russia gas supply. For quite some time now, Russia and China were contemplating constructing a new pipeline to supply Beijing with more gas. Novak has confirmed the deal is coming and the agreement will be signed really soon. And if the Siberia 2 pipeline comes online, this will provide China with 50 billion cubic meters of gas through Mongolia. And this is gas at a much cheaper rate than in Europe. Now, of course, Putin clearly lays out the advantages for China and Russia. Nobody can get in the way of this, neither sanctions on tanker fleets or even sanctions on financial institutions. In addition, transactions will be done in bilateral currencies as well. And if we consider US China relations today, it's just a matter of time before this happens. China and Russia, they share a common border, so this just makes logical sense. Because gas is transported through a pipeline, you can't impose a price cap. How can you? You also can't shut down Russian tankers. You don't even need ships in the first place. So the sanctions are effectively useless at this point. The gas will keep flowing whether you like it or not. It secures China's energy supply. And this, of course, allows the Chinese economy to rocket ahead of the West even further. And that's how big of a deal this is. So if Beijing contains their property crisis well and gets even more cheap gas from Russia, China's economic growth will explode. It will confound the West. But let me know what you think. Will China's stimulus work? And will Russia continue targeting Western assets? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.